All right. Hi, everyone. We are live. Welcome to Market Matters. My name is Katie Coots, and I'm a social media editor here at CNBC. I'm joined, as always, by our senior markets correspondent, Bob Pisani, and today we're going to be answering all of your questions about the latest stock market moves. Nice to see you, Bob.
Hello, Katie. Good to see you as always. Happy holidays.
Happy holidays. I know you've been doing some traveling recently. How's that been going?
Yeah, we went to the Caribbean a little while ago. My wife and I traditionally abandon our family for the last 10 years and go to a different Caribbean island. And we went to Antigua this year. It was lovely. I never went on beach vacations before. If I went on vacation, I went to a city, Paris or Rome. But I really enjoy beach vacations. Maybe I'm just getting older, but we do a little island hopping and, find some nice restaurants. And once a year, it's quite relaxing. I really enjoyed it.
Yeah, well, especially this time of year, it's nice to kind of get away and escape the cold Northeast a little bit.
Yeah.
So happy to hear that. Keep us updated as always on all of your travels, Bob. But lots to talk about today. So let's jump into it. First up, what has been driving stocks recently? What's going on with the market, Bob?
Well, it's Goldilocks. We use that phrase a lot, but what does it mean? It means interest rates are declining. We were hitting 5% on the 10-year yield in the beginning of November. It's now down to 4.4%, somewhere around there. Inflation readings have been coming down. We are seeing some modest slowdowns in the economy, even in the jobs market, but not much. It's not that serious. It's slower, but it's not that serious. And we're seeing estimates for earnings go up in 2024. We could talk about that a little bit. We had this morning consumer sentiment numbers came out. They were stronger than expected, which the market likes. So the market's fine with things slowing down, lower interest rates. They don't want things to slow down too much. But this is what we call Goldilocks, not too hot, not too cold. You look at the S&P, we're right near a 52-week high. And we're not far from the historic high. The old high was 4,800, 4796, I think it was January 3rd, 2022. We're 200 points away from that. The math, it's less than 5% from a historic high. So essentially, we're at a 52-week high. We're up almost 20% for the S&P for the year. And we're not far from a historic high. So overall, the reason this has happened is because inflation numbers are moving in the right direction. The Fed, the street investors have come to believe the Fed is essentially done raising interest rates. And there's a substantial group of people who believe that they're going to be cutting by the middle of next year. That may or may not be true. Wall Street people can certainly get overly enthusiastic and overly pessimistic about the future, and they can get it wrong. But right now, the least likely outcome has happened, which is Goldilocks and a soft landing, we call it. And the reason that it's the least likely is whenever the Fed historically has raised interest rates as aggressively as they have in the last year, the economy usually goes into a recession. If we're going into a recession now, it's a pretty darn mild recession so far. Now, heaven knows what will happen in the middle of next year. We don't know. But so far, last year at this time, the market was predicting that the U.S. would be in a notable recession by the middle of 2023, and that has not happened. That was wrong, that prediction. So historically, when the Fed raises rates like this aggressively, normally you have a more serious downturn. That hasn't happened yet. Maybe it's because all of this money sloshing around from COVID has helped keep people going. I think that's a big part of it. But regardless, right now, the market's holding up darn well.
So, Bob, I know we've talked in the past about it's hard to make predictions about the future, but what is Wall Street predicting for 2024?
Well, they're bullish. I mean, first off, you ought to know Wall Street is generally a bullish crowd. And the reason they're bullish, generally, historically, is number one, the market tends to go up. 3 out of 4 years, the S&P goes up. So the overall market, not everything, obviously, but the market tends to go up. It has to do with the nature of the capitalist system, number one. Number two, it's always better to be bullish than bearish. Generally, Wall Street strategists and analysts have, their careers are better served for them to be bullish because of the long-term nature of the way the stock market moves. So strategists are people who study macroeconomy and make predictions about what's going on, including where the stock market is. So Wall Street, JP Morgan, Goldman, all those people, they have ways of looking at the economy, then estimating where they think the stock market will be. And those strategies are bullish. So, a lot of them put out estimates for 2024 year-end S&P 500. They're north of 5,000 or at 5,000, a lot of them. So, the S&P, if you do it from here, that's almost the 8-9% gain for next year predicted after a 20% gain that we've had almost so far this year. So that's pretty bullish. Analysts are people who study individual companies. We call them bottoms up because they study from the bottom, individual companies, and make estimates about where their individual companies are going to be going. So the Caterpillar analysts will estimate where Caterpillar's prices and earnings are going to be a year from now. And they are aggregated into the S&P 500, and we get an estimate on what the total earnings for the S&P 500 are going to be from the analysts. So you have these top-down people, these strategists that use these macroeconomic models. Then you have these bottoms-up people, these analysts that just analyze individual companies. So even the analysts are optimistic. They're expecting earnings for the S&P to be up about 11% next year. They were flat to slightly up this year. We haven't got the final numbers yet, but yeah, you're looking at estimates somewhere around 2%, 3%. It's not going to be a big up year at all, but it'll be up. So the bottom line is these analysts and these strategists are all pretty bullish. Now, if you want to be a cynic, and I've done several stories, if you're interested, you can go to tradertalk.cnbc.com and read them about how strategists and analysts are wrong. They are usually overly bullish, and their numbers are usually off by varying degrees because stuff happens in the middle of the year that throws the forecasts off, macroeconomic stuff. A pandemic, a huge recession, a terrorist attack, a major hurricane, an earthquake, anything. You'd be surprised how many, people say, oh, it's a once in 100-year flood, once in 100-year recession, once in 100-year pandemic. But if you add all of these once in 100-year events up, they actually happen very often. So you have to learn how to look at statistics and probabilities and understand that once in 100-year events actually happen fairly often because there's a whole bunch of them that can happen that can throw things off. So you get very humble about this prediction business. It's not very good. People aren't very good at it. And one reason is the future is unknowable. Stuff happens. And another reason is there are biases. People their ways of thinking are infected by the biases they have. And in my book, Shut Up and Keep Talking, I list dozens of these. This is very well studied. People are overconfident, for example, in their ability to predict things. People exhibit herd behavior where they follow other people blindly and adopt their biases. People think that what happened recently is an indication of what's going to happen in the future. It's called a recency bias. There's dozens of biases that infect the way people think and throw off the accuracy of their forecasts. So I do this. I follow what these people are saying, not because I think that they're brilliant or soothsayers, but because they can help me formulate my own opinion about the future. But I have no illusions. I would never make a stock market investment based on what some strategist said about where things were going to be 1 year from now. Believe me, that's not a good way to invest in the stock market.
So, Bob, something else interesting that's happening this month is Uber joining the S&P 500. So what does that mean for the company and for investors?
Well, I did a story on this Trader Talk page the other day. You can look it up again, tradertalk.cnbc.com. I'll give you the simple answer. This is great for Uber because Uber's up almost 8% since this announcement was made. It was about a week ago. And it was already going up in anticipation of that. There are rules for inclusion in the S&P 500. One of the rules are you have to be profitable in that last quarter, and you have to be, the sum of the last 4 quarters have to be profitable. And Uber's a big company, so it's known it was a candidate, and people have been sitting around waiting for these 4 quarters of profitability to happen And there's been speculation for a while. So that speculation drives the price up itself. So it was helped by the fact that they had good earnings out in the early November. I think the revenues were up 70%. The market was rallying too. So you throw in these three things: speculation going in the S&P, market rallying, good earnings report. Boy, the stock, just look at the chart in November. It's been up rather noticeably. Unfortunately, this is bad for holders of the index, of the S&P 500, because they're buying Uber at a very high price. Uber is expensive. The market capitalization of Uber is $120 billion. And that's going to be about the 66th biggest stock in the S&P when it goes in. And so what's going to happen is all of us who hold the S&P 500, I own the S&P 500, are going to have to pay a lot of money to put Uber into it at the market capitalization that it represents. It's, by the way, going in at the close on the 15th, which is a week from today. This is what we call the S&P inclusion effect, where a stock tends to rise going into the S&P 500 because people anticipate that it's going in. And once it's announced it goes in, price goes up even more. Here's the one funny thing. After it goes in, there's a tendency for it to underperform. And that's because a lot of the demand, it pushes the price up artificially. This happened to Tesla. I mean, we saw this in 2020. I think that was announced in November of 2020. When it just blew up because Tesla was such a big name. It was the 5th biggest stock in the S&P when it was put in. So they had to buy a huge amount of this stuff. And it went up for, about 50%, some crazy number. And then after it was in, it basically flatlined for a while. So there is an inclusion. And this is the good side and the bad side of these indexing. Years ago, it didn't matter that much. It was an academic exercise. But now there is $12–13 trillion directly or indirectly indexed to the S&P 500. That's a huge amount of money. If you want to know how big it is, the current value of the U.S. stock market is about $45 trillion. And 80% of that, $35 trillion, is in the S&P 500. And when you think like 12–13 trillion of that 35 trillion, that's more than a third, the total market is in there, owned by index funds or people who are closet indexers. It's a remarkable amount of money. So this stuff now really moves the market because of the growth of passive indexed investing, which I very much believe in, by the way. You should pay attention to this. It's, like I said, good news for Uber investors short term. Longer term, I don't think it necessarily matters that much. But it's an interesting effect.
So, Bob, something else that we've talked about on the show before is the possibility of a Bitcoin ETF. Is 2024 going to be the year that we get a Bitcoin ETF, and what would that mean for Bitcoin?
Yeah, I think it is. And, I've been very critical of Bitcoin in the past. I don't think it has a lot of use cases, frankly. What is it for? What does you use it in your portfolio for? Does it tamp down volatility? Does it add diversity? I'm a big believer in blockchain and the technology around blockchain, not so much around cryptocurrencies. But I do think there will be a Bitcoin ETF, and I'm a supporter of the idea. If people want to play Bitcoin, that's fine. The great thing about an ETF structure is the same reason it was good for gold. In the old days, when you wanted to own gold, you had to go out and buy physical gold. You had to keep it. You could lose it, and you don't want to hold this physical thing. The Bitcoin ETF came, you had vaults where custodians that would hold in for you, essentially. That's what a Bitcoin, and you can do this now with GLD. There's a vault in London that holds all this gold. I've actually seen it. I've been in it. It's amazing. And there are Bitcoin ETFs when they come in that will hold them in custody for you. So you don't have to worry about losing your password. You don't have to worry about getting stolen because there's a custodian that's going to guarantee it to you. You'll have it there. This satisfies a lot of the problems associated with it, with owning Bitcoin, with the fraud and the custody around it. And so I think it's a superior method, and I'm supportive of it, even though I'm not particularly supportive Bitcoin in general. So I think it is going to happen. We've talked about this a lot. There's a January 10th date where the SEC has to indicate whether they're approving, in this case, it's Kathy Wood's ARK fund, the Bitcoin ETF that she's applied for. There's about a dozen of them that have companies that have applied for this. They're not all the same. So the SEC has to go through each one of these. They're not exactly the same. So they have to go through and respond to each one of them. But we have seen them, the SEC, engage with these companies, ask questions back and forth. That's, if they were going to just try to figure out a way to stop it, they wouldn't be engaging in this level of detail. This is why everyone is optimistic that something's going to happen. The most likely scenario is they will approve as many as possible, all at the same time, not necessarily on January 10th. I don't think it's going to happen then, but there'll be a structure that will be set up for them to approve multiple Bitcoin ETFs, probably in the first quarter and likely, almost certainly in the second quarter of 2024. So I think it's coming for better or well. You can see the effect that this has had. Just the speculation about this has driven Bitcoin from 30,000 to 40,000. So there's an effect. There's an inclusion effect here that happens just like Uber was going up, going into the S&P 500. People buy. Now, whether or not this is stealing from any advances Bitcoin might have in 2024, who knows? But I can tell you, well, this is a well-studied phenomenon, inclusion effects. So you can draw your own conclusions.
Well, definitely something we'll be watching closely in the new year. Next up, Bob, what's your best advice for new traders? Maybe people are looking to get involved in the stock market. What's your advice? Well,
you and I have talked about this many times, and there's a whole chapter in my book, Shut Up and Keep Talking, about this, and my own journey doing this over 33 years. And it's very simple. Have a plan and stick to it. Don't day trade. It's really, day trading involves market timing, where you think you think you have some information that nobody has about when to go into a stock and when to get out of it. Day trading, you're doing on a daily basis. I can tell you the vast majority of everyone doing this loses money. And if you make money, you're probably lying to yourself about whether you're outperforming the market, whether or not it would have been better for you just to put money in the stock market and just watch it grow rather than spend all your time trying to outsmart the stock market. So number one is don't day trade. But number two is understand risk tolerance. How much can you afford to be in the market? How much would it bother you if the market, like last year, went down 20%? Understand, investing is a very long-term game. That's the way to make money. You get rich slow. You save a regular amount every week in a retirement fund, and you put the vast majority of it in low-cost index funds. In my book, I tell you what I own. I'm one of the very few people that actually do that. And it should be no surprise to you, my single greatest holding is the S&P 500 fund. And it doesn't matter how you own it. I own it as an ETF. You can own it IVV, SPY, VOO. These are one's a Vanguard, one's an iShares. It doesn't matter. You're just tracking the S&P 500. You are the market. The S&P is 80% of the stock market is the S&P 500. $45 trillion U.S. stock market. The S&P is 35 trillion of that. So do the math. It's pretty simple. It's close to 80%. So, and then I own a small cap value, I own a mid cap, I own an international. It's diversified around. And I own some bonds. I own money market funds. And they have finally making money after years and years of nothing. And it's pretty diversified. But the single biggest holding is the S&P 500. You buy on a regular basis. The other thing, you're going to live a long time. You're going to be shocked at how long you live. I am almost 70 years old. I am still planning to live to 90. And most of the actuarials tell me I'm in reasonably good health for a 70-year-old. Tell me that it's likely, now that I've made it to 70, I'll make it to 95, and I'll probably be wrong. You don't want to outlive your money. So I might have to adjust that. But that's a long time. That's another 20 to 25 years for me. If you're 40 years old, trust me, the technology is going to improve. You're going to live to 100. So if you're 40, you have 60 more years of investing. What happened last year? Down 20%. You all thought it was a disaster. It wasn't a good year. It was terrible. But it's a blip. It's not going to matter. We're almost back to where we were. So in a year. So that those down years don't matter. It's the cumulative effect of all of the up years that matter. And that's how I've done it. And people look at what I own. And again, it's in the book. The list of the stuff that I actually own is in the book. It's not very long. People look at it and they say, this is what you own? You've been the stocks correspondent for 30 years at CNBC, and they keep thinking that I'm going to bring in some obscure investment they've never heard of. It's super nerdy, leveraged inverse Malaysian bonds or some crazy stuff. And I'd say, no, actually, all of that's a lot of baloney. I own stuff for decades, and I'm reasonably well off just because I've been investing slowly over the years with stuff that you think is boring, like the S&P 500 or small cap value fund or mid cap or basic international fund or a money market fund. I have 5% my retirement and money market fund. Why isn't that a good idea? 5%. That seems like a pretty darn good idea to me. I know a lot of people have more than that in it. So just remember, understand your risk tolerance. It's a long-term game. Don't day trade. Buy on a regular basis and recognize you're going to live for a very long time.
Well, I think that's very helpful advice, Bob, for our audience. So last up, final question. Bob, what are you asking for the holidays?
Well, Christmas is for the kids. We don't, in my family, I have 3 brothers and sisters, and we don't even give presents to each other. We haven't for years, but I have 8 nephews and nieces, so that's for them. For me, my mom always gives me something. My dear mother is 95 and still alive. God bless her. But she always gives me a jazz CDs. I'm an old jazz fan. I mean, 1940s, 50s, 60s, Miles Davis, Count Basie, all that stuff. I've grown up with that. I've been listening to that music for more than 50 years. And there's always some new issuances of something obscure in the 40s or 50s. Miles Davis live at the Plug Nickel or something like that. And you'd think there would be not enough, they'd run out of reissuances. I mean, how many obscure live jazz albums from the 50s could there be? But they always find something. And so my mother always gives me some obscure jazz CD reissuance. I usually tell her in advance because she doesn't follow that. So it's pretty simple. What's great when you get older is I don't want for things. I spend a lot of time on experiences. I love music. I love going out to the theater. I love having dinner with my wife. I like nice bottle of wine. You don't get too fancy on things. I don't own a fancy car. I don't own a fancy house. And part of the thing is, and this is Charlie Munger, who died recently, Warren Buffett's partner, keep your expectations low. I never owned a Lamborghini. In theory, I could probably afford a Lamborghini if I did it on a monthly payment, but I don't want one. I don't care for one. I drove a 20-year-old car until very recently. I bought a new one, but it'll probably be the last new one I buy in a long time. So heaven knows. Keep your expectations low. Keep your head down and, work hard and keep a close family around you. I always say, I know I'm getting a little philosophical, invest more in relationships and less in stocks. It's a good maxim to have. It's in the back of my book again. Sorry to promote the book, but I have a section in the back, my favorite sections, maxims, 58 maxims on life and television, things that I've observed over the years and try to put in short, pithy sentences. So the jazz is a hobby of mine for the holidays.
Yeah, well, that sounds great. Definitely relationships, experiences. That's what's most important. Bob, thanks for answering all of our questions. Thank you to everyone who sent in.
Thank you, everybody. And I'm not sure we'll be talking before the holidays, maybe, but if we don't, everyone have a healthy, happy, and safe holiday season.
You too, Bob. All right. Thanks, everyone.
Thanks, Katie. Take care, everybody.
Bye.